without the delay.
That would be nice.
Should I say check? Okay, it works. Ladies and gentlemen, good afternoon. I'm very pleased to announce our discussion today focused on art securitization, or put it simpler, we're going to look at art as an alternative investment class today. And we're going to try to offer different perspectives for this discussion. We're going to work in two sections this afternoon. There is a first panel, which I'm going to introduce in a second. And after a short break, we're going to have a second panel. We have Russian language translation available at channel 5. When the discussion is going to switch to Russian in the second panel, you'll be able to follow this discussion in English on channel 1. I'm very pleased to and very proud to present our panelists for the first section. Next to me is Philip Hoffman, whose name I would say is synonymous to the art fund. I think Philip has been the veteran of art fund industry and one of the pioneers of art fund industry, and probably is the largest art fund manager with verifiable track record today. Next to Philip is Professor deMarchi, who is teaching for many years now at Duke University, and wrote some fascinating books about the history of art economy and looking at art as investment class. And he's really going to be a pleasure to have his remarks heard about art as investment class today. And finally, we have Serge Tiroche from Artist Pension Trust. And I remember when I put together this book, Art Investment Handbook, we had Artist Pension Trust as one of our case studies for innovative collective investment schemes for the art market. And it would be very interesting to hear your views on how this particular approach to art investment develops. I would like to start by offering maybe a few minutes of context for our discussion today. It's been long known that various parties and various groups of investors have been looking at art as one of the alternative investment classes over years. But this year, in the year 2009, offered a really interesting new perspective to art as alternative investment. No matter which statistics you're going to be using, if you look at the high end of the art market and artworks from the well-established names in a price category of anywhere between $500,000 and $20 million, you would see that this top quality art did preserve value for its investors extremely well over the crisis times of 2008 and 2009 and 2010. In fact, the art market grew tremendously and was really enjoying very robust demand throughout 2010, and we have a lot of data to back it up. You had some of our presentations on the website, some of them are distributed here. I wouldn't bother you with all the numbers now, but this is a scientific fact that while many assets were, like traditional investment assets, were not performing, and that was what the crisis was about for institutional and individual investors, seeing the value destruction of enormous proportion in many traditional asset classes. Art offered fantastic shelter to those who put money into top quality art and really helped to preserve the value during turbulent times. Unfortunately, economic uncertainty is not going away, and in that context, art continues to offer a very interesting alternative investment opportunity to those who is willing to consider that. The biggest question which remains is whether we're going to see new classes of investors in the art market. So far, this is market dominated by high net worth individuals and various institutes or foundations or museums they create to structure their investment into the art market. But so far, we haven't seen really dramatic growth of institutional demand for high-end art coming from the traditional finance industry. We don't really see significant asset allocations to art from big-name asset managers, and we really don't see a lot of structured product being offered to financial markets with art being an underlying asset. And I think one of the questions that we would really try to attack today is if we see this revolution, I would say, coming, and that there is going to be a broadening demand for higher quality art from institutional institutional sources of capital. And I would like to start this discussion by asking Philip to comment on what he has seen in terms of evolution of art market infrastructure on the institutional side. Does he think that art funds are really the ways to go going forward? And why maybe there are not so many fantastic funds like the Fine Art Fund that you've been managing over the years?
Thank you very much. Well, I came into the art market by mistake. I'm not a passionate collector of art, nor do I have any art on my walls at home. And I joined Christie's when I was 27 as finance director as a skeptic. Why was art of any value? When you compared one Venetian view with another, why was one worth 20 million and the other worth 5,000? And when KPMG asked me to join Christie's as finance director, age 27, I said the last thing I want to do is join a bunch of old Etonians selling Rembrandts. And I said I'll do it for a year and then I'll go and do a proper job. And when I was at Christie's, I saw how much money the really super rich were making out of a buy and hold strategy at the top end of the market, and I saw how many dealers were very successful and how many dealers were very unsuccessful. And I saw who the major players were and how the money was made, and that was an interesting insight. And when you saw clients who were buying Canaletto for 50,000 in 1976 and selling it for 3 million in 1991, so over a 15-year period, the returns looked quite interesting. And I then looked at the British Rail Pension Fund that put a equivalent of about 200 to 400 million into art back in 74 in today's money, and saw their returns, which were interesting, 13.3% returns they made, which was probably not as good as equities at 17% over the period, but it was an interesting alternative asset class. Now, I founded the fund 10 years ago. We manage about $100 million of assets in the fund, and we then have private funds that we are managing or in discussions that might amount to probably 200 million of, in addition to that over 2010-11. So we're managing, in art terms, quite a substantial amount of money, but if you're talking about an oil trade, that is probably one trade for Goldman Sachs in 1 minute. So we're in a different scale from the rest of the financial world. So given that we're one of the larger players in the market, 100 or 300 million is neither here nor there. And why, and in answer to your question, why are the institutions not yet rushing in with 5 billion or 10 billion? The first issue is, when I spoke to CalPERS, one of the biggest pension funds in the States, they said, we love the idea of investing in art. We think we can see that that gives diversification. But if we were to invest in it, we would like to put about 1.5 to 2 billion straight in. And tell me what's the size of the market. And I said, well, the investable market, although the total market is estimated at somewhere between 30 and 50 billion per year, what I deem the investable market is about 10 billion. So CalPERS' arrival with 2 billion would skew the market fairly rapidly. And they said any less than that wouldn't move the needle on their diversification and their correlation data. So one of the reasons why the big institutions have shied away is because the market is simply too small. The other issue is, I've been around probably 4,000 people around the world. I travel 200 days a year meeting all the ultra-high net worth and family offices and institutions, and we see what they're looking for and they want to tick 5 boxes. They want to tick off that where they are investing, there is a track record, there is honesty and transparency. There is a demonstrable team that has been together for a period of 3 to 5 years. There is professional indemnity cover. There is theft and fraud and all the other covers. And in today's economy, where people are worried about what happened with Madoff and what happened with some of these other funds, a lot of them are scared about doing something new. And what we have managed to do is to start to convert some of them in a small way into investing with us, and we have about 100 investors from about probably 16 of the Forbes top 1,000 invest with us, and we have some institutional money, but relatively small amounts of institutional money, because they don't really want to be a first mover. Harvard, CalPERS, etc. We're either too small, the art market, or our funds, or alternatively, it's too risky for them to do it and go alone and stand out from the crowd, because you don't get fired for copying what every other pension fund did, and you don't get any additional bonus for investing in an art fund from being a fund manager.
Right. Thank you, Philip. I think this is interesting that so far with all this experience and effort that you've been putting in place to put together the Fine Art Fund Group, you've seen that a classic model of the art fund is so far getting a limited traction with institutional investors to date. I would like to go to Serge and ask you to talk to us about your way of collective investment in the art industry, and maybe briefly describe the fairly interesting, innovative structure you put together, and tell us if you see that there is a way to scale this form of investment in the art market that you currently have.
Thank you. I'll speak a little bit about Artist Pension Trust. This is an innovative concept where the artists are actually the key investors, and not necessarily the high net worth individuals or institutions. But we also rely on high net worth individuals, obviously, to fund the operation of the company. The company was started about 6 years ago by an Israeli gentleman called Moti Schneiberg, who came up with this idea while talking to artists and realized that really they don't have a way to plan for their own financial security in the future. They cannot have a normal pension because they can't make normal contributions into a pension program because their income isn't secure. So he came up with this idea of pooling artists together and creating a risk diversification mechanism for them. And the company was launched, as I said, 6 years ago with 8 trusts around the world. In each trust, we have curatorial committees, expert curators who actually nominate a certain number of artists for participation in Artist Pension Trust, and the committee selects those artists that they think have the best prospects. The types of artists we're looking for are mid-career artists. Mid-career meaning they've already had a couple of major exhibitions. They're probably looked after by 1 or 2 leading galleries in 1 or 2 major locations around the world. Many of them have represented their countries in biennials or have had major exhibitions at museums like the MoMA or the Whitney or Jeux de Paume in Paris. And the idea is that artists that are invited to participate agree to put aside over a 20-year time span 20 works of art to be included in this trust structure. And the company really in that way creates a pool of up to 5,000 works of art and basically manages that collection, lends it out to museums around the world over a long-term period, stores the artwork, insures it, ships it around, shows it at various places. We're now showing in Art Basel Miami, for example, in 3 different art fairs. There's some material about the artists we're showing in the back if you're interested. And eventually the artworks get sold, and when the work is sold, 72% of the proceeds go back to the artists. So that's why I say the artists are really our key stakeholders in this company. An artist whose work is sold receives 40% of the proceeds directly of his own sale, and the other 32% of the proceeds go into a pool, and all the artists participate in that pool. And they get really pro rata shares depending on how many artworks they've invested in the pool, in the program. As I said, we have 8 trusts around the world today. The company started 6 years ago. We've already signed up 1,300 artists. The collection at the moment is about 5,000 works of art, and it's growing every day. The company has been funded because we haven't started selling yet. Then we don't have an income stream, so the company is funded by private capital from investors, and the type of investors we've had Again, very similar investor profile to what Philip Hoffman has in his fund. Mostly private individuals who are art collectors, but see this as a way to diversify in an asset class that's historically has shown higher returns than the more established when you're looking at contemporary art, but it's obviously a much higher risk asset class. And the beauty of artist pension trust is that it provides diversification for the investor in terms of the number of artists and the number of works, unlike any other vehicle available today. So, as I said, about 60 investors. We've raised about 14 million in capital so far. And we now have a very large family office who's interested in investing the next round of $5 million. And, with $20 million, I think that will be sufficient capital for this company until it really turns the corner and becomes break even, because it retains 28% of the proceeds of sales.
Thank you, Sergey. I think this is a very interesting description of another way of trying to mobilize collective investment in the art industry, and you definitely managed to scale it and build a trust around the world. You are yet to prove the actual returns on this APT to your investors, and we all hope that's going to work for you. But I would say this is an interesting concept which is yet to be tested, and we'll see, what economics it's going to yield to its investors.
I think there were two key tests that we had to figure out. First of all, artist participation. When the company started up, the key risk was, will artists understand what they're going into? Do they have this long-term horizon? Are they going to stick to a contract? And I think that's one test
that's
passed
proven
successfully. The second test is really the marketability. And the big issue for us is, we do have to sell at some point and start returning capital to our artists. But much of the value is in the long-term appreciation of the collection. So it's always a difficult decision to approve an artwork for sale, and that really depends on what other artworks we have for the artist, how have the prices evolved. But we have a sales committee that reviews works from the collection for sale on a regular basis, and the selection is made based on numerous criteria, and we're only just starting to enter the market with some sort of works for sale. So we'll see how that goes, but I'm pretty confident. We've had some good responses already.
That's great.
Confident.
We'll be watching you. Professor deMarchi, on that note, I would very much like to get your contribution. And I think one privilege you have is you've been studying the history of art market for a long time and of art economy. And maybe the discussion that we have about how to broaden the investor base for the art market and bring more institutional money into the game in this or another context has been discussed before in the past, and maybe art as an asset is already a known animal to you in terms of its attractiveness and marketability to long-term value investors based on the history of art economy and art market. Is there and I would appreciate you commenting on that.
Sergey omitted something when he was introducing me, namely, he thinks of me as a constructive contrarian. And that's my role, I think, up here. I'm not an investor. I know about investing only secondhand, and therefore what I have to say is based on what I do know something about, which is how art markets have worked in various places and at various times. But I want to start really by posing a question to Philip. You saw me writing a lot of notes. That's what I do. I write notes and think I know something, and then I discover I didn't really know that. At least I've been contradicted in what I thought I knew. Philip suggested that they've done very well in his fund out of investing in quite high value works. There's a famous paper in the art economics literature by a pair of people at the New York University Business School, May and Moses, who started the business of constructing significant resale price indexes covering a long period of time. They argue that you can't make much on high-value works. They cost a lot to begin with, and the prospects of further increments are less than on other kinds of art. So, can I ask that question of you, Philip, and get your response on that?
I mean, I disagree with that, and I can give you $50 million of transactions I've done in the last 3 years where they're all high-value deals, relatively, and we've made 14 million of profits out of 50 million of sales in the last 3 years. And, you know, it's public knowledge. I'll tell you some of the deals, because what we pride ourselves about is openness, transparency, honesty, and just to give you a flavor, we sold Glenn Brown's Darley Christ at Christie's this year. It was one of the top lots in London. We bought it from New York for 1.1 million. We sold it at Christie's for 2.25 million. We bought it in 2007, supposedly at the peak of the contemporary market, and we sold in 2010, supposedly at the lower point in the contemporary market. We bought a old master painting on the day that the catastrophe hit Lehman Brothers on October the 1st, 2008 for 4.75 million, and I sold it on the 2nd of October, a day later, for 6 million. 1.25 million in one day is an interesting return. We, at the bottom end, what I would deem, we bought a Cindy Sherman, bought it for 70,000 and sold it for 260,000 last month at Christie's. We are in the market all day, every day. We are looking at the higher end of the market. The most expensive thing we bid on was Raphael at 27 million. We hold very little investments of $5,000. We do have a Middle Eastern fund that looks at Middle Eastern art, where we buy at the bottom end of what May Moses might describe. But I'm not convinced about the index and I also, if you look, we're at the operators in the art market, the really serious trades are very confidential and dealt with by some of the top players in the market, not necessarily at auction. And when you see some of the margins on the top end, they're not always disclosed. You don't see them going through necessarily the auction houses. And I feel that the rarity value at the top end is much more interesting. I think that what we are doing is we are investing in blue chip art, where we think the upside is perhaps 50 to 100% return within a year to 2 years, and we feel that the downside is not more than about 10%. So when we buy $1 million painting, we're looking at downside at 900,000, upside 2 million, and we have seen the bottom end of the art market as being very unstable. The $10,000, $20,000, $30,000 works of art. If you bought a $50,000 work of art in 2007, it's probably today worth about $25,000. You probably lost 50% of your money. Highly, highly risky. But if you, if I look at all the holdings we have made 27.35% IRR on every asset sold. We have sold 50 million of assets. We have KPMG who actually audit what we sell. We have Christie's and Sotheby's who value what we sell, and we have seen the best results at the top end. So all I can talk about is from practical aspects rather than theory.
Well, much appreciated. I think, Professor deMarchi, before I go back to you and let you talk about some of the key takeaways from the history of art economy and art market, which you think are relevant for today, let me just offer a few numbers. As you know, we use, as a company, something called Skate's Top 5000, which is the sampling of world's most valuable artworks by auction prices. The weighted average effective rate of return on repeat sales in this peer group is currently 4.4% per annum, which really demonstrates that for high value art, there is a verifiable, consistent, positive investment return. And the threshold price for top 5,000 currently stands at a little bit over $1.8 million. So we are talking about really high value pieces here. What's also interesting is that once you go over about $20 million a piece, there is almost no way you can make a positive return on these investments. There are, of course, instances, but statistically, there is almost no verifiable track record of people who are paying over $20 million a piece making money on that investment. And we have a very detailed explanation why we think this is happening, but this data and statistics is available on our website, which you can check. And going back to you, Professor deMarchi, what you think would be the interesting takeaways from art history for us to know as far as talking about art as investment class going forward?
I'm not sure how much the history has to offer, because art markets have evolved considerably, and the history gives us instances of early practices which we now recognize, but I'm not sure that there's a great takeaway directly. But I did find what you just said, Sergei, interesting in relation to what Philip said to us. It's always the case that if you say, but you can't possibly make money, the practitioners say, but I do, and I did. Both cannot be right. Philip is honest. I take his word for the numbers he gave us. So what's going on here? It is interesting to hear Sergei say that if you invest over 20 million, you're unlikely to make out well. If you invest in the 1.8 million range, you have a chance. That accords perfectly with what I know about art markets, which is if you trace the distribution of prices, then there are a lot more extreme values, both at the high and at the low end, but especially at the high end. That's to say, there are a lot more events which are not part of a normal distribution. That means that using the statistics that we all know about a normal distribution, you cannot predict what's going to happen at the extremes. It's consistent with that general finding that if you take the extremes as being 20 million or so, you can't predict what's going to happen out there. Anything may happen, a lot of wins, a lot of losses. If you come back a bit, perhaps you're out of that range and back into the normal range where we think we can predict much better. But I was intrigued by what Philip said also, which is we're in the market all day, every day, all day, every day. That means that there's a lot of information coming into the fund which the normal investor does not have. I think if you make money at the top end, not the very top end, but the top end, this is going to hinge in greater degree on intimate knowledge than is the case in financial markets, say, where you have hedges. You can hedge against the S&P 500. You can cover particular deals. You short a stock, you buy a call option, and you've covered yourself. And many more complex things than that too, obviously.
I think to add, just to focus on your comment, we have 50 people working with us worldwide. We're in Dubai, we're in Greece, we're in New York, Paris. We are looking at the art market every day. We are at every art fair, every auction. We're involved in trades of around 500 million a year. So we are seeing some huge volumes. We're looking at about 100 million of art a month, and we're picking out 2-3 million of deals that fit the criteria of investing for our funds. And we're looking at like distressed deals. We're looking at deals where, for instance, Maastricht, old master painting offered at 5.2 million. Client needs cash tomorrow morning, and Philip Hoffman's Fine Art Fund offers 750,000 to buy it, and the client says, "I'm not happy to sell it, but I need the money." Now that is a opportunistic deal, and what we aim to do is provide instant liquidity if that's what the client wants. We also pay world record prices for works of art where we believe that we have insider information that will lead to that artist doubling or tripling because of 10 or 20 factors that the Fine Art Fund believe in that will transform the value of that work of art from, say, 1 million to 2 million.
Beautiful. This says it all.
Yeah, that was a risky word.
You cannot...
Expertise is a better one.
Yes. You know, the statistics say you cannot make money at the very highest end because you simply can't predict what's going to happen, and anything may and does happen. You can't read anything into trend lines which you think indicate something for the future. None of that is true. What is true, and Philip supports this strenuously and correctly, if you know things that nobody else knows. So if you have private information, it needn't be called insider information, but it's knowledge shared by people who are working the market intimately, doing particular deals, private treaty sales and purchases, so that you know the circumstances behind the sale in a way which is simply impossible in the market as a whole. So I see absolutely no contrast between what we're each saying, but it is interesting that these things came out in the conversation. I think it's very, very helpful.
Well, thank you for that. I think we would open questions and answers in about a couple of minutes. So I would appreciate you coming up with interesting questions, contributing to this discussion. But before we do that, I wanted to offer Serge to comment on the following, and then of course you feel free to add what you want to add. I think before we nail down art investment as something that has no future because it's based on inside information and unequal access to information for institutional investors who would always feel that they are deprived of the same knowledge as is available to market insiders, maybe it would be a stupid question to ask, but I love to ask it, and I have no problem to ask it in front of this beautiful group of people. Why don't we try to brand art investment as socially responsible investment? Because that really worked for a lot of industries over the past. And CalPERS, that the institution you talk to, they are really sensitive about it. Why don't we say that really by building institutional investment vehicles that are going to bring money into the art market, we're going to allow for distribution of capital to creative talent, which is otherwise deprived of opportunity to contribute to the society. And this is really such important function that the institutional investors can contribute to our society by really supporting these funds. And for you who is managing APT, where you can ensure the distribution of capital to, I wanted to say green, but I'm sorry, to socially responsible means of investing. What would you say about that? And then, of course, feel free to add other remarks you want.
Sure, thank you. I think APT is a social business, and that's the way I describe it in many of the papers I write and the articles I write. I think it is a way to support the artist community, certainly, and I think that's why it's a bit different from the Fine Art Fund. But I have to say that I think there's a place for all kinds of investments in art. My background, maybe not all of you know, but I was in wealth management for many years, working for Citigroup, and I built their wealth management business in Israel and Turkey, and I have a lot of experience in all asset classes, really. Fixed income, hedge funds, private equity, you name it, everything. But my family has been traditionally in art. My father was an art dealer, dealing in Impressionist and Modern. I have a brother who's in that business, so I understand really, from micro cap in the art world to large cap blue chip, which is what Philip does and my family do on a private basis. I really believe, having seen all asset classes, that art is a very unique asset class, despite having numerous downsides, like very high transaction costs, for example, which is often cited as a problem. But there are a lot of advantages in the asset class. The fact that it's very niche and you need a lot of expertise, the margins you can make in art, the fact it's not transparent, it's getting better, obviously, with websites like Skates or Mutual Art or ArtNet, ArtPrice. You can get a lot of information about art, but it's still a very specialized niche market, which means you have very high margins. I think one point, that looking at art as an investment from a financial perspective, as a financial portfolio manager, I would say that perhaps the most important thing about art is not the research that demonstrates that art makes anywhere between 6 and 10% per annum on average, depending which research you look at. More importantly is that correlation in all of the researchers I've seen to other asset classes is practically zero. And that is really the key advantage of having art in a portfolio, and I think that's what we need to focus if we want to educate the investment community to invest in art. The primary reason is not return, but it's diversification. And art is a store of value. It's a real asset. It's got a little bit of the traits of gold, for example, or real estate, but it's independent and it's different. And I think art has place in everybody's portfolio. It's just a question of educating. And I think one of the things I have in my mind in order to achieve this really is to take APT and I don't need CalPERS to invest in APT because I'll never have the size, but I can skip CalPERS. The beauty of APT is that we're formed as a company, and one day we can IPO the company and make, for a $10,000 investment, you can get a small share of the world's largest, most diversified contemporary art collection in the world. And that's something.
That's a securitization for you.
That's a securitization. So,
do you want to add something to that?
Well, I like to be contrarian. I would disagree that there is no correlation between art and the financial markets. I think what we are seeing right now is that the top end of the market, the $1 million plus rare art, is making new world record prices, and the bottom end of the market, if you're prepared to sell, you can get half what you paid for it 2 years ago or 3 years ago. And so I think that what we are seeing is the rare end of the art market going up, because that's what all our clients and the world's rich and the museums want. And at the bottom end, it's difficult to give away some of your less expensive art and get your money back. I don't think you'll get your money back. And I think there's a very strong correlation between the equity markets and the art market under $100,000 as a rough band.
All right, perfect. Well, at this stage, I really would like to welcome questions from our guests today, please. And maybe I would really appreciate if you can talk into a microphone, and we'll get you one in a second. Yeah, here you go.
Hi, thanks.
Thank you, Ben.
Melanie from the Art newspaper. I've got two questions. One, Philip, can you explain what you meant by the investable art market, the 10 billion versus the 30 to 50 billion?
Right, and by that I mean we look at the art market is not one market; it's 70 markets, from toy dolls and motor cars, dinky toys, all the way to Cézannes and Picassos at 100 million. What we deem the investable market is different segment by segment. So in contemporary, we might not say that the Damien Hirst is the investable market, but we might say early. Unique Damien Hirst might be part of the investment horizon. So we try and subcategorize where we think money is to be made, what is rare, what is in diminishing supply, as against there are huge numbers of categories of art, and we exclude a lot of them because they're too small, they're too illiquid. Tribal art, wonderful thing to collect, but not necessarily. You couldn't put 5 million into the market today because you'd buy the whole market.
And then, thank you very, very much. Sergey, I love your idea of art as a art market as a socially responsible investment. But isn't the problem that if funds like Phillips that start at 500,000 to 20 million, or even APT, which is mid-career artists, that actually the artists who really, really need the money are way below the radar? Right.
Well, first of all, it was just an idea. I don't have, and I really wanted to steer a discussion. But at the same time, if you really want to start thinking about that, then I don't know. It's not necessarily need to go to aspiring artists, because I think there has to be a recognition by the society of the well-established names, and I don't think these well-established names necessarily have perfect access to capital to implement on some of the ideas. I think sometimes this capital comes with strings attached or nationalistic agenda attached, and I think sometimes you really want to have a free artistic hand allowed for the society by the capital which is there to support it. But again, that was just an idea.
Melanie, just to answer a point you raised, mid-career artists aren't wealthy, I guarantee you. Many of them have a hard time finishing their month, even if they're mid-career and they've had 1 or 2 exhibitions. So it is a social business. I wouldn't invest in it otherwise.
One thing that came up earlier was this issue of transaction costs and the art market. If you compare the art market investing in art and the transaction costs of doing so compared to investing in the stock market. Clearly, investing in the stock market, the transaction cost can be 0.1 or less, and investing in the art market, the transaction cost can be as high as 40 or 50%. And that is obviously off-putting to the private investor. But I think what we've seen is that if you are a bulk buyer or bulk seller in the market, those transaction costs can often be close to zero. And in our case, we have a vast number of examples where the actual cost of doing business, buying and selling, can be close to zero. You know, the cost of storing is about $100. The cost of insuring is about $700 per million. So to buy and sell a $1 million or $2 million painting, the transaction cost might only be $700 or $800, and then the rest of it, in terms of finding buyers and finding sellers, because of our team and because it's mainly in-house, we don't really have necessarily huge transaction costs.
All right.
If we assume that the world art turnover is something like 50 billion a year, sorry, let's just,
I can hear.
Yeah, we can
We
hear
can.
you.
assuming that the world art market is 50 billion a year, let's just assume that, and roughly half of that goes through dealers, right? And the other half through auction houses. So half of the transactions are not transparent or not evident. So how do you manage to evaluate the actual worth of specific artists if half of the market is sort of darkened down and you don't know for how much the painting's been sold?
I think that's, you know, we have a team who are involved in that market, who know most of the key dealers. We know a great deal about the private transactions that are going through, and that's why we attend the art fairs. That's why we're at all the auctions. That's why we spend a lot of time in the market talking to those dealers and picking up information. And you know, if you know your way around the market, you can find out most of that information, and it's reasonably reliable, but not 100% reliable. People often say, "Oh, I sold something for a vast amount of money," in fact, and it wasn't true. But you know, the key is doing that homework and finding it out. You shouldn't just look at the auction transactions because they're not totally. They don't cover the whole market.
Okay. We might have time for a couple of questions. Yeah, please, at the back. No, yeah, please.
Thank you. Amy King from ArtNet. I just wanted to ask, you've talked quite a bit today about the opacity of the art market and how insider information often benefits people who have specialized and privileged knowledge. I was just wondering your opinion on if that market were different and if more identities were known of buyers and sellers, dealers' private inventory, private sales, prices that dealers achieved, if you think that would benefit the market, if it would increase participation and confidence, or would it be destructive because of what it would do to the way the dealer system works now?
That's a difficult one to answer.
Give it to Neil.
You do want to have it?
I think that's a difficult one to answer. It's very tricky. I mean, if you are more transparent as an auctioneer, you're liable to have more active bidders. That's in a very specific context. If you force dealers to reveal everything, as you suggest, and is often maintained, you may destroy the market. I don't think we should stick with this word insider information. That's a legal term which doesn't apply to the art market simply because there's not enough things explicitly on paper as to what good conduct amounts to. But what I hear Philip saying constantly is do your homework, know your market, know your people, know the circumstances. If you know enough detail, you have private information which gives you an edge. But nothing wrong with that.
All right, and maybe the last question, and we wrap up for the break. Yeah, please.
Hi. I think this was very interesting, so thank you. But we're sort of here in Miami, which is really the mecca of invitations and exclusivity and parties and face-to-face buying and selling. So can someone or anyone sort of comment on the how that gets included or excluded in the transaction processes that you're all referring to? Because I think that's sort of a big prompt for people who enjoy the art market. Certainly everyone here is very interested in it, but so I was just wondering if anyone could comment on that.
That's what we mean by high transaction costs.
That's exactly. well,
Could I say something tangentially related to that? That we often don't count all the transactions costs, but nor on the side of owning art do we ever think of the joy and daily pleasure you have of living with the stuff. That ought to be a component of any rate of return calculation. And if you get a great rate of return, fine. But if you also live with the stuff, you get a better rate of return.
Absolutely.
I think that's a lovely conclusion of this panel. Thank you very much. And let's reconvene in 2 minutes. Yep.
2 minutes. That was just wonderful. Thank you. It was so informative. I mean, you said exactly what I wanted to hear, but it was very
Thank you. That was brilliant.
Thank
Thank you very much.
Thank you, Serge.
Thank you.
That was just great.
Neil, thank you
Nice
very
to
much.
meet you.
Brilliant.
Heard a lot about what you do, so well done.
And I heard about yours as well. I was like that.